Good morning, traders and investors around the world. Welcome to this Monday, June 27th, the last Monday in June edition of Premarket Prep Plus with StockOdds. Joel Elconin joined by Rob Friesen here, and a little bit of red on the screen. Failed to reach that pre-market high, 39.48, coming up a little bit shy at 31.75. Pierced that pre-market low, not by much, only a 1.5, and now we're trying to go back green on this session. Crude, that's up 83 cents at 108.45. Gold in the red by 320 at 18.27.10. Building a major wall there at 18.50. Silver, that's in the green by 17 cents at 21.295. Bitcoin clinging to 20, down 655 at 20,600. Ethereum futures, they're in the red by $49 at 11.66. Let me stop the screen share, bring on Rob here. And his topic for today is going out on a limb. And I didn't get a lot of the details of what he was talking about. But what I think Mr. Friesen is talking about is like, you have a big day on Friday. Right. Big rally. The bull is back. We got to get in there and you just got to buy hand over fist, but not so fast. How's that for reading the tea leaves, Rob?
Not too bad. I mean, have you ever been up on, this is not ladder safety, by the way, but have you ever been up on, the very top rung of a ladder and you're trying to do something, change a light bulb, or you're trying to, clean the gutters or whatever it is. If you leaned one way or the other, you could have a bit of a problem, right? Yep. So it's that kind of feeling after you have a massive rally. I mean, we were up over 6% for the week. It was a shortened week, 4 days, but that's the second best week of the year so far. And so, last time we had a big rally, we ended up going back down. There's that potential this time as well. So we have to look at everything, and it's never easy to approach a day where you want to make production for the day, but you're dealing with this massive move, and then you're kind of sitting right out on a limb. It's just how it felt to me. And I want to show you something here from the numbers. Let's see, share screen. Okay. So this is from StockOdds, and it's RSI 2, and the output is open to close, just for our four horsemen we talk about, the diamonds, the Qs, the SPY, and the IWM, the Russell. And so this is the odds for, again, just for today, open to close. So what you have is lots of events that have happened that are very similar to, like we got up into an RSI 2. Now, RSI 2 is much more sensitive than RSI 14, right? It's a 2 period. So it's better for sort of day-to-day trading and getting some information that way in terms of, whether you're overbought or oversold. So, by observation, we looked a little bit overbought in the short term, right? And so when it has hit that same RSI in that bin, plenty of events in the last look back period of 2,000 days. So that's a good sample of data. And it's showing that, yeah, the tendency is that we do still have the opportunity to move up a little bit, but the actual average performance of all of those events is negative. And that's right across the board. That's only for today. Okay, this is open to close. So this data was available to you from Friday, looking ahead into today. Okay. Yep. And then what did we have? We had the futures up overnight. We ended up opening with a gap up from the previous day's close, and we pulled back from that, right? And many of the stocks were actually gapping up. And this is where your limit orders versus market orders really become important. If you're stacked on top of a massive move that's already happened, and you're getting information like this to say, hey, it's a little bit treacherous because it's out on a limb. It's, sitting Humpty Dumpty on a fence. We don't know. It's really important that you pay, that opening price that you want, that you're comfortable with. Because if you're gonna pay up something that gaps up 2%, and the market starts to pull back, those things drop. It really hurts. So just think about that. Think about, okay, getting to choose the price of your participation. The other thing you can do, we've mentioned many times on the show, is you can actually throw your hedges out there first. If you're doing sector hedges, you want to buy some oil stocks, you want to buy this or that, whatever. They have a corresponding sector ETF, or more specifically industry ETFs. You can throw those out and get short first and see how the market treats those, and you could buy second, right? Or you could just be conservative in your limit orders and see what you get filled on. And then if the market's responding well, you can go in and buy the other ones. They're already up. So, I mean, the reality is you're probably not going to pay too much more than the open to get in those, but be very strategic. Okay. We're going to have these events, in the future as well. So you're going to see this movie again. But now let me show you something. This is for today, right? And it's all across the board on the fence, the average performance and the Sharpe ratio, not massive, but negative, right? So a little bit positive odds, but negative on performance. That's over all those samples. Now we're going to flip it to the next 5 days. Okay. So this is from the close of Friday to the close of Friday coming up. Now look what changes. Odds 61.9, average performance positive. So even on the back of that RSI, when we've had short-term overbought conditions, the market may have had an adjustment within those 5 days, but ultimately the performance has been extended. And this fits what I was thinking in terms of what should happen with how the markets have come out of the hole, starting on not last Friday, but the previous Friday, which was expiration. And we had indications that they wanted to start chewing on some tech stocks again. We had indications that the market was feeling different on that day. It followed through on Monday and Tuesday. And then we had the really nice week of performance. So everything fit with what we saw. We talked about that, letting the market breathe, letting it move up, not fighting the rally. And then, I would expect that to continue. So let's just look at, here's where we ended up Friday. This is the pre-market session. We did pull back a little bit to tag the previous close. We rallied up. And so we were still at a premium relative to the previous close when we opened. And it just pulled back, kind of like that rug pull feeling everybody's experienced many times. But again, from an open to close perspective, we didn't have great odds for today. But if we go to the daily, I fully expect that there is the potential, and probably should be happening, is that we go up to test this consolidation right up in here. Like that's the move that's potentially there from this expanded. We went from a slide down the Bollinger Band. The Bollinger Band squeezed. They opened back up.
Okay.
So the volatility component here and the potential is to move right back up into this consolidation, which was from May 27th, and we finally broke down on June 9th, right? So markets tend to do that. They move from consolidation trend to consolidation. Then they break, then they trend, then back to consolidation. And you can see that in the past over and over again repeating. But that was a very interesting, remember we commented on how that was squeezing into quite a channel there, and it related to the low from February 24th. Well, that would be my target right up in here. And anywhere from 407 to 417, anywhere in there is fine. But that would be how the market probably should play out this week after a pause and rest.
Okay.
Again, I don't know for sure. This is just giving you my thoughts from experience, but also looking at the data, which says that the next 5 days could be very positive, after we get over the hump here, after we stop kind of teetering on the limb. Now, that also corresponds with the last 3 days seasonality. There's some seasonality that we have to look at. And the other thing is, Friday is going to be a very light volume trading day ahead of the long weekend. There's a couple reasons for that. One, you have people taking a 4-day weekend out of convenience.
Yeah, that was the other
Right?
thing I was going to mention. You have the end of the month on Thursday, and then you have a 4-day weekend. So
Right. So there may be some window dressing end of the month. There may be some people have to answer for why they're not in some of these stocks that have had a move this month already. There is also the Russell follow-up rebalancing and benchmarking that happens after the Russell's completed. You have, and that covers most of the stocks that we trade. All the Russell 1000, 2000, 3000, and the lifestyle type of funds and all that. You're going to have probably big imbalances at the end of the quarter, end of the semester. Once that's sort of dealt with, then the next day is very light volume. Canadian markets are closed, so you don't have the Canadian institutions trading on Friday. So that takes a fair chunk of volume away too. And then Monday's a holiday, July 4th. So, and then we often have a transition after. You remember some of the events that we've had where the market hit a high in the first week of July, and then we ended up selling off a bit after that. So there is the tendency for a bit of a change after July 4th. So keep that in mind. But I'm just kind of curious this week whether we can rally like should be happening, and there's a concern for Friday with the light volume. If the bulls are in charge, you could really have a melt up. If the bears are in charge on Friday, well, it could melt down. So it's going to be curious. But it's not only month-end seasonality on Thursday. Friday is the first trading day of the month, which is positive for July. It's also the first Friday of the month. It's light volume. It's ahead of a long weekend. I mean, there's just so much crammed into that one day, besides any other economic reports and things like that, right? Other note, you've got Shopify on Thursday or Wednesday. I forget what day it is. Wednesday, maybe. No, it's actually tomorrow, the 28th. Shopify is 10 for 1, right? 10 for 1. So that's an interesting stock. We saw the Amazon. So it's nice to see some of these higher price stocks get marked down, and after that they've often had some pretty good runs, so keep that in mind. But anyway, I just wanted to bring that up. I think that's about all we need to cover right now. One more thing, sorry.
That's all right.
I wanted to look at so this whole thing is centered around inflation, deflation, inflation versus recession and all that kind of stuff. But I put up the monthly chart here. I just want to look at, we still have the crude complex, oil complex, energy complex, really stretched out, and that this one's a harder one to read day to day because it's got so much volatility and it's so geopolitical and everything else. But you're seeing copper now. In my career, I've always used copper as a bit of a sign of recession and global growth versus not. And it's pulling back hard. This is a monthly chart, so that's June. It's pulling back hard, and there's just a massive air pocket still. So that tends to play into the recession argument more so. And you've got, as far as things concerning inflation, you remember how we talked about the commodities and to watch them for just signs of inflation and signs of systemic problems. But we're seeing it start to change now. Corn is pulling back, which is one of the major products the world consumes. Oats, right? Soybean oil, even, wheat starting to pull back, even in spite of everything that's going on with the Ukraine. Canola oil used largely in cooking. Look at that 1 month move. Cotton, for clothing, everything else. Look at that 1 month move, massive.
Yeah, I mean I tell you, I mean, you got to be leading. I mean, that CPI data comes out in the middle of the month. I mean, that comes out benign, and
Yeah,
this market's gonna rip. And
I know.
I've noticed that in the commodities too.
We're really positioned for a summer rally, like some of the other events that we've had in history, where people, things were bad.
Rob, you just moved the S&P's 20 handles with your bullish talk.
Well, I appreciate that, but remember when Dennis was having such a problem with lumber in his house there, and look at
yeah, I know.
that was like he high-ticked it there. Maybe I'm just teasing him, but
I know.
but lumber's come back too. So just look at the commodities for information, just as we look at the futures for information on interest rates. The treasuries, the bonds, what is actually happening, and it's foreshadowing, it's foresignaling. People that are much smarter than you and I, Joel, are crunching all this stuff, and they're the ones that are taking the larger positions. This is not a retail move in cotton. This is institutional, right? It's and then look at our 2-year note. Look at all the treasury. I mean, we had the massive sell-off in bonds, and we may have a bottom in on that. So what does that mean? And then we've got still a strong US dollar. Like I said, if this ends up, continuing to rally, it only softens the commodities more so because they're priced in US dollars. But anyway, I think you can get some clues. This is quite dramatic by showing you the monthly, but I think it's important. It gives a little bit better perspective than just sitting here and looking at the 5 minute trying to figure out where are we going next, right?
Yeah.
Okay, so I'm done. Appreciate that. And
okay, pre-market prep with stock odds. We're now in the green by 6 and 3, 7 handles here, 23 and a quarter. So pre-market low, taking it out by a 1.5. Now we're rallying. Intraday high 31.75. Nothing there for you folks. Pre-market high 39.48, and I don't have anything there for you there. The next relevant level on the upside is an intraday high, not a real high, but an intraday high from June 10th at 39.59.50. Everyone, thanks for joining us. Back with you tomorrow, same time, same place.